All right, I think we're live. So, hello everyone. Thanks for joining us today. This is our second webinar of the year, I think, and today we're going to be talking about 2021 tax planning update. We're going to be going over some tax laws and such. For those of you that don't know me, my name's Crandall. I'm one of the managing partners here at Premier Wealth Advisors, and Joe is a managing partner as well, Joe LeBlanc, and Kuhn is joining us, our in-house resident tax expert. So a couple housekeeping items. There's an attendee chat function on the left side of your screen. Feel free to use that to pose us any questions along the way. I'll kind of be keeping an eye on that as we work through the presentation. And if you want to make this presentation full screen, on the right-hand side, upper corner of your screen, you'll see a little box, square box, and if you hit that box, you'll get the slides in a larger view. So let me get this going here. All right, there's our pictures in case you can't see us in the video. And all right, so we're going to be going over primarily federal tax law today. And, I do want to throw the disclaimer out that everyone's situation is unique, and please do not take the guidance that we give you, specifically to your situation. Take it as general information and double check how it applies to your situation before you take action on it. And we are always here to answer questions and be a resource for everybody. So I just wanted to mention that from the get-go. So on that note, Suyen, I think I'm gonna turn it over to you and let you run with it.
All right. So I just wanted to cover the important tax dates, and this is a normal year, if you can call it a normal year, where the filing date actually falls on April 15th, unlike a couple of the last previous years where it could have been the 16th or 17th. And obviously, if you still need an extension, you can get one until October 15th, which is 6 months. But just remember that you still need to pay your payments by April 15th to avoid any penalties and interest. And then the estimates are, if you have to pay taxes on your own during the year, there are the normal due dates of April, June, September 15th, and January 15th of next year. And Joe is going to tell us a little bit about fundamentals.
So really quick comment on this. So last calendar year, with COVID, they extended the tax deadline. And so we've had a lot of questions. Do we still got to file on time this year? So that's why we just wanted to go over this information. And another interesting piece is if you file an extension, that does give you 6 months to finalize your taxes. But if you owe, that payment was technically due on April 15th. So it is possible that you'll get if you owe and you pay after April 15th, even though you did file an extension, that you might get a follow-on bill for some interest and so forth after the fact.
And that is always true. And one other big picture caveat is tax law, especially for 2020 and 2021, is still evolving. And so, all the things we're going to cover today are still subject to change based on what's going on, both at the federal and state level. And big picture, when you're talking about tax law, the federal tax is, the big dollars. So that's where the most money is in terms of income taxes you owe, tax credits on the federal level. On the state level, those tend to be a little bit smaller, the amount of tax that you owe and the types of credits that are available for your income taxes on the state level.
There is some pending legislation as well between the Fed and the state this year still that might be retroactive for last year, right, Joe?
Yes, it's the Consolidated Appropriations Act that was passed in December and created the stimulus round 2, was not fully absorbed or conformed by all the different states. California in particular did not agree to all those changes yet. And so that's part of what we're seeing is California is starting to catch up and other states are starting to catch up with that particular tax law change. So things like making the PPP loans deductible, or the income not taxable, but the expenses deductible. So those things still have to be worked through at the state level.
Right. I'm going to talk a little bit about penalties and estimated taxes, because those are always questions that we get during tax time. Is, hey, I'm going to pay late. What's this mean? And so forth. And it's there's a lot of different penalties and things that they'll hit you with if you're late. And I got to look at my notes to keep track of it all. So there's a failure to pay penalty, and that penalty, and this is IRS, that penalty is 0.5% per month that the tax is unpaid, up to a maximum of 25%. There's a failure to file penalty, which could be in addition to the failure to pay penalty, and that's 5% of the tax due each month with a maximum of 25%. And then there's there's also penalties for frivolous returns, negligence versus fraud. And as far as estimated taxes are concerned, it is required that if you want to avoid a penalty, that you pay 90% of the current year's tax liability or 100% of the prior year's tax liability, or 110% if your income's over 150,000. So the short story on penalties and estimated taxes is they are there. They will catch up with you. It's better to respond to notices, file extensions, and deal with tax issues, even if they're painful. So at least you can understand what your tax burden might be. And I always say some communication with the IRS is better than none. And a lot of guys are like, dude, I know I'm going to owe. I don't want to file because then I'm going to owe. It's like, no, file. So at least you don't get the failure to file penalty. And if you owe and you don't have the money, you could set up an installment plan. There are ways to resolve issues. So just be aware that ignoring tax issues is not the solution. So all right.
One good point on that, Ari, is even if you do set up an installment plan, that does not stop the penalties and interest from accruing. It just allows that payment plan to continue without the IRS or the state filing an action against you, so levying your house or your wages. So it's a good thing to have an installment plan, but it doesn't stop the penalties and interest. The other thing to recognize is states all have corresponding penalties. Whatever the IRS has, the states have a similar penalties, smaller percent, smaller dollar amounts, but those all apply. And for states like California that are essentially broke, guess what? They are starting to press on every one of those penalties that they can to try to wring as much tax dollars out of you as they can.
Yep.
In general, penalties can be waived, not all of them, but some of them, but interest cannot. And so if there's an interest due because you still owe tax after April 15th, that always will apply and cannot be waived, but sometimes the penalty can be waived.
Yep.
And just a quick check-in. So is my microphone better now?
I think it is.
Okay.
We had a little technical challenge on Suyen's mic working right before this started, so we had to flip her to a different login. So hopefully the mic situation's resolved. So thank you.
I just wanted to comment on Ari. You did make up a good point there, that you definitely want to file even if you can't pay, like you said, because the failure to file penalty is a lot greater than the late payment penalty. So just at least get it in there, and then you can work out the payments later. That's all.
Yep. And quick note, if we're not looking up at the screen, it's because we're looking at the attendee chat and getting back to people. So thank you, Mr. Younger, for letting us know on Suyen's mic. We appreciate that. We do have a question about mileage rates with gas prices going up. There's no pending legislation on mileage rate changes at this time, for those of you that take a mileage deduction. So, all right. So now we're going to just get into income fundamentals, kind of defining what is income and what are exclusions and things like that. So I'll turn it over to Suyen and Joe to go through this stuff.
So the first part of the income fundamentals is looking at what makes up your gross income. And so gross income is all your income from any source. And by the book, if you're walking down the street and you find a $20 bill on the sidewalk, that is income that you are supposed to declare on your tax return. So that's one thing a lot of people kind of miss is there are multiple income sources. It's not just your W-2, it's not just your 1099s. You are responsible to report all of your income. What is otherwise reported to the IRS is a different part of that equation, but IRS Computer is doing a lot better job on comparing electronically filed data from employers and banks and financial institutions and matching that with tax returns. And that's why the e-file mandate exists, so they can do that matching. One in particular exclusion to gross income is the stimulus payments, the economic impact payments or recovery rebate payments to individuals. That is not considered income, and that was specifically in the tax law that was not income.
Right, and some of the other exclusions, which are normal in every year, are gifts, as long as it's less than $15,000 per person per year. So a married couple, for example, could give somebody $15,000 each, so a total of $30,000. So those are excluded from income. Inheritances, child support, bond interest, municipal bond interest, workman's comp, things like that. So those are also excluded.
So we had a question about cash income, right? And we are self-reporters of revenue. Businesses are self-reporters of all revenue. But I always give the example of when a client comes in and pays for a tax return, we report that revenue, right? We self-report that revenue, and technically you're supposed to report all of your revenue that you receive as income, and so that's how cash accounting works. We also had a question about property tax deductions, and so we'll get into the deductions as well down the road. Go ahead, Joe.
Well, let me just follow up. We do have a voluntary income tax system, meaning you voluntarily disclose your income to the IRS under the fear of audit. And so it's not without a stick on the other side. We have had clients go through actual audits, soup to nuts, looking at everything. And one of the things the IRS does is subpoenas your bank records. And so we had a client going through a bank through an audit, and the auditor was sitting, across the table from me and the client, going through the bank account records and saying, okay, what is this deposit? Please explain. What is this deposit? Please explain. And so if there's a trail, that is findable income that the IRS could find in an audit. And that's always the stick. If you choose not to declare it, that's up to you. But in the case of an audit and it comes out later, then there's bigger penalties for, at that point, fraud or failing to report income that you should have.
All right. What about inheritance? All right, we have a couple questions about inheritance and how is that taxed? Is that income or not? And I know the answer is it depends. So Suyan, what do you think about inheritance?
Right. So generally for inheritances, it's not taxable, but obviously there may be situations. So talk to us, give us a call, and we'll go over the details. But in general, no.
Right. The capital asset is not taxable, but if there are income attributes, so if you get a stock that pays dividends, those dividends are still taxable. The question is just, was it taxable to the estate or taxable to you as a recipient once you receive those stocks? And then other things like IRAs and 401ks and annuities are taxable to the recipient. So you do have to be careful about the characterization of the assets you're receiving. Are they a type that is considered income even to the inheritor?
Right. So we'll get into other income stuff down the road. I want to keep the pace moving a little bit so we can get everyone out of here on time. All right. Let me.
Well, let's just let me hit gambling income and losses really quickly.
Sure.
The best advice is don't. It's like an all or nothing deal on gambling winnings and losses. So gambling winnings are considered part of your gross income, but gambling losses are an itemized deduction.
True.
And so if you're taking a standard deduction and you do not have enough losses from gambling, then essentially you do not get any benefit for those losses, even though you may have had a net zero or a net, out-of-pocket loss for gambling. Those W-2Gs that you get for gambling are part of your income no matter what. And California, still has the itemized deduction phase out. And so I, painfully recall one year we had a client that had something in the order of $1.5 million of gambling winnings, and then $2 million of gambling losses. But because his total income was so high, all those deductions were phased out on his California return, and he ended up owing more California income tax than federal income tax.
Yep. Yeah. Usually it's a couple thousand in winnings, couple thousand in losses. The dial doesn't move a whole lot, but like I mentioned at the outset, everyone's situation's different. So
yep.
It's not always a 1-for-1. All right. So deductions versus credits. This is an area that we get a lot of questions of clarification as we work through tax season. So I just wanted to kind of re-review what a deduction is versus a tax credit, right? So a deduction is something that allows you to reduce your taxable income, and the impact that the deduction has is relevant to your tax bracket, usually, right? So there's something called an above-the-line deduction and something that's called a below-the-line deduction. So above-the-line deductions are things that you can write off even if you do not itemize on your taxes. So as an example, for those people that would qualify for a deductible IRA contribution, that's an above-the-line deduction that would reduce your taxable income. So simple math, if you're in the 30% tax bracket and you put $5,000 in an IRA, it would save you $1,500 in tax. So there's above-the-line deductions. An added above-the-line deduction that we were going to talk about later that came through some legislation this tax year is a $300 charitable contribution is now an above-the-line deduction for the 2020 tax year.
If you're taking a standard deduction.
If you're taking the standard deduction, yes. So tax credits, which we're going to get into later, are dollar-for-dollar offsets for taxes. So there's child tax credits, dependent care credits, retirement saver contribution credits. There's all sorts of credits that are built into the tax code. Non-refundable credits are ones that are applied against a tax liability. So you have to have enough taxes for those credits to be applied. If you have no tax, those credits usually go away or some of them carry forward. And then there's refundable credits, and these are credits that are given to you regardless of your tax liability. So this is the situation where typically if someone's a lower income earner, they oftentimes qualify for some of these refundable credits. So, it's the person who had $1,100 in withholding, for example, on their W-2, and they got back $5,000, right? And depending on the nature of their return. And those someone who would qualify for refundable credits. Our job as tax preparers and advisors when we're working on your returns is to make sure that we're keeping track of all these things and advising you about, hey, what do you qualify, what do you not qualify for, and also some forward looking items and being proactive around these topics. All right, so we're going to move on to standard to deductions. The standard deduction changed a couple of years ago, and it went up quite a bit from what it used to be. So, Sian, do you want to walk us through the deductions, please?
Sure. Yeah, absolutely. And like you said, Ari, nowadays, because of the Tax Cuts and Job Act, about 87% of people take the standard deduction because it is so high and it's a lot easier. So for a single person, it's $12,550. Married filing jointly is double that, $25,100. So in addition to everything on this table here, those who are 65 and older or are blind, you get an extra $1,350 as an additional standard deduction. And if you're single or head of household, you get an extra $1,700. And if you're both over 65 and blind, you get double that amount. And this also applies to married filing jointly. So you could have that $1,350 times 4 up to $5,400 if you're married, both are over 65 and blind. And then there's also a standard deduction for minor children under the age of 18 who have to file a tax return. And it's the same as it was last year. Children always get $1,100 as a standard deduction, and if they make an income more than $750, you get to take whatever they earned in income plus $350 up to the amount on this table here. So I hope that's clear.
Super clear, easy to remember. That's why we have it all typed up. So,
Which changes every year.
Yeah. So one thing to keep in mind is this is federal standard deductions, and California has a much lower standard deduction. And so oftentimes, people will take the standard deduction on the federal return if they don't have enough itemized, which is, itemized deductions are property taxes, charitable contributions, property taxes up to a limit, charitable contributions, mortgage interest, et cetera. So oftentimes we have it where, a client will take a standard deduction on the Fed and then itemize on California. And, like I said, our job is to make sure that we maximize, the offsets on those as much as we can. So, but
and that's one of those good examples of California not conforming with federal tax law because of those itemized the standard deduction changes and itemized deduction changes and the Tax Cuts and Jobs Acts that California did not agree to.
Right.
A lot of clients are still itemizing for California.
Okay. So speaking of tax acts, the most recent one was the Consolidated Appropriations Act, or CAA, of 2021, which was actually signed into law at the end of 2020. And this was the second largest piece of legislation that went through last year. So a lot of people refer to this as stimulus number 2 instead of stimulus number 1. Sian, do you want to walk us through some of this, please?
Yeah, so like I already said, this is signed at the very end of December, and there's 2 parts to this act. One is the standard federal fiscal year spending that they pass every end of year for the next year. But the part that's most interesting to us is the $900 billion in COVID-19 relief. And that's what we know as the second stimulus bill. And just as a reminder, the CARES Act from April of 2020 gave us the first stimulus package of $1,200 per person plus $500 per dependent. And the second stimulus gave us $600 per person, whether it was an adult or a dependent. So, but there are some rules to this. So we're just going to go over some of the highlights to that on the next slide.
All right. So this is probably the biggest question, right, all through tax year is, what about these stimulus payments? How do we deal with it on our taxes, and so on and so forth? First off, the stimulus payments are not taxable. Okay, the $1,200 that each person received or was potentially entitled to receive, and the $600 stimulus number 2, there is no capture back on those if your income was over the thresholds. And the stimulus you received was based on your 2019 tax filing. And so if there was a change between your 2019 taxes and your 2020 taxes, the taxes we're filing today, right, then, and you didn't get stimulus, you have to indicate that on your tax return so that there's an opportunity to scoop that stimulus back up. So a lot of folks, we're finding, didn't get paid their stimulus, had a reduction in income, which allows them to qualify. And you need to go through and manually mention it on your tax return by indicating how much stimulus you got, and for each stimulus 1 and stimulus 2. So stimulus number 1 was $1,200 per person in the household, plus $500 per each dependent. And stimulus number 2 was $600 for each person in the household. So taxpayer, spouse, kids, $600 each. So there is some planning opportunity here to pick up some of that stimulus by being proactive on your tax return. So I've already had at least close to half a dozen clients this year where that have kind of been on the bubble of phasing out. It says on the slide it's reduced $5 for every $100 over the thresholds mentioned. One way you can lower, if you're right on the bubble of those thresholds, is, I had one client that made a couple of IRA contributions, it lowered his taxable income and allowed him to scoop up some stimulus that he didn't otherwise qualify for. So these are technically refundable credits, right? That we talked about credits earlier. And filing your return is really the primary way that it determines whether or not you qualify. And will, if you don't indicate anything received, then they're not going to manually send you out a check. You need to indicate on your tax return, did you get a stimulus? How much was it for, et cetera. So,
and the IRS has said if you don't request it, they will not add it to your return. But if you request more than they think you deserve, they will reduce your return or your refund.
Yep.
So it definitely makes sense to, apply for as much as you legally can qualify for.
Yep. So short answer, let us know how much, if you got a stimulus, yes or no, and how much did you receive. So, and the first stimulus number 1 came out in May-ish 2020. Stimulus number 2 probably showed up in January for most people, but it is a 2020 payment. So it is reportable on the you have to indicate it on your 2020 taxes. And a lot of clients said, oh, I got that in 2021. We don't got to worry about it. It's a 2020 stimulus that you received in 2020. All right. Moving on. Oh, quick question. Who is not eligible? Non-resident aliens are not eligible. Anyone who qualifies as another person's dependent is not eligible, and of course, estates, trusts, entities, etc. I don't know.
People holding ITINs.
Yeah.
So if you had an ITIN and not a Social Security number, you are not eligible.
Right. I don't know off the top of my head the rules around married filing separately on qualification. We had a question about that, but if you send us an email, we'll look it up and get you the answer. All right. All right. So what about children and stimulus rebates? That's a question we have oftentimes, if the child claims themselves and files their own return, right? So, Suyan, do you want to walk us through some of this information?
Sure. And the definition of child here is a dependent on your return. So this is a qualifying child on your return. Somebody who's under the age of 24 if they're a student, or under the age of 17. So if a child claims themselves, they file their own return because they're required to, they have enough income. Unfortunately, because they're a dependent of you as the parent, they do not get their own stimulus. However, the parents get it, which is why it's read that the child doesn't get it, but the parent gets it. Now, if the child is above 17, then technically they're not entitled to it. But because this was based on your 2019 return, if your child turned 17 in 2020, then the parent gets it. So that's an extra bonus there. Now, if you claimed a child as a dependent in 2019, but not in 2020, perhaps they turned 18, or maybe the other spouse claimed it, then you got the credit, you got the stimulus check, and you don't have to pay it back. So that's nice. But the person who actually does deserve it can claim it on the 2020, and then they can get it back. And just to clarify, the only people that have to pay back any stimulus checks that they received are people who received it for a deceased person. So perhaps you got it for a deceased spouse, or a parent who had passed away. They filed a 2019 return, but obviously they won't be filing one for 2020. Technically, you need to pay that back. But that's the only case that I know of where you have to pay that back. Is that right?
As far as I know.
Yeah.
What about, Joe, didn't you have a client who had a baby like on New Year's Eve?
Yes.
And
So, yeah, one of my clients had a baby on New Year's Eve, and this is that gray area of technically they qualify for both the $500 first payment and the $600 second payment, which is how we're going to file the return and let the IRS say no. The law does not actually specify that they had to be alive on the date that first payment was made.
so
And so, yes, if your child was born, just to go back, all right, if your child was born or adopted in 2020, obviously you did not get a stimulus check in 2019 for that, but you can claim it as a recovery rebate credit on your 2020 return. And then also bonus for those recent college grads who can no longer be claimed on a parent's return, they can file their own return and get those rebates or those stimulus checks today.
All sorts of fun stuff. So it's probably been our number one go back question to clients and things that they have to look up. I think I got it. I don't know if it was the full amount or maybe it was a little less. So anyhow, Joe, we have a couple examples. We've kind of talked about these numbers already, but we thought maybe we'd kind of illustrate them for those of us that are more visual versus auditory learners. So do you want to walk us through these real quick, if you don't mind?
Right. So this is assuming that the second check did not go out in December or January or was not received. So in the first case of Remy, a single taxpayer with one child, there's the two $600 payments that they get. So $1,200 would be added as an additional credit on their 2020 tax return. For Anthony and Cleopatra, who are married and have no children, same deal, because there's two people in the household. They would qualify for up to $1,200 additional credit on their 2020 tax return. The Brady's, however, as you know, two parents, six kids, they're the big winners in the equation. As long as all the kids are under 17, that's 6 times or 8 times $600. So there could be a $4,800 credit on their 2020 tax return, provided that their income is low enough and not phased out. And so that's really the next part of the equation is, where do those monies start going away? And as we kind of touched on at the beginning, the qualification for the stimulus payments for the first one anyway was based on your 2018 or 2019 tax return, whichever was the most recently filed. But 2020 is where it's actually determined. However, if you got money based on 18 and 19 and didn't actually qualify for it, they're not going to take it back. That's the one good part of the equation. But you may not get any more. So let's flip to the next slide. We got rid of that slide, didn't we?
We did get rid of that. Confusing. I think we had too much detail on this, so we trimmed it back. All right, so we're going to move on from stimulus and just talk about some recent exclusions, some exclusions from income. For emergency workers, there are some exclusions for mortgage debt cancellation and employer payments of student loans. So there's some legislation out there that's pretty interesting. So, Joe, do you want to go over the emergency workers scenarios, and maybe I'll cover the mortgage debt? Does that sound all right? Or you want me to run? I'll run with it.
Yeah, why don't you?
All right. So emergency workers. So these are like volunteer firefighters, medical responders, etc. So, and of course, we got to read the notes because there's so many interesting things here. So members of qualified emergency response organizations can exclude certain state and local government payments received for their volunteer services. And this is an exclusion that was going to expire in 2020, but it was made a permanent exclusion in 2021. So this was part of that legislation that went through. Suyan, is that right? Part of the CAA legislation? And so that's pretty interesting. So if you got paid if you got some local or state government payments for volunteer services, there is an exclusion there. Of course, we got to dig into the code and reconfirm where did the payments come from, what exactly were they for, and do they qualify? But it's an interesting piece of information. Qualified mortgage debt. So we haven't seen, this has kind of been extended since the recession 10 plus years ago. And remember, California law doesn't always conform to federal law. We're talking federal law here, right?
Yeah, so California does not apply to the debt mortgage cancellation exclusion.
Yep. So if a lender cancels debt, the borrower must include the discharged amount in income, and you can get an exclusion of up to $2 million of discharged debt on a principal residence. This was due to expire at the end of 2020, and the CAA legislation extended the exclusion until the end of 2025. and but it lowered the exclusion amount down to 750,000 for joint filers, and that's kind of in line with the mortgage interest deduction that was modified as well around that same level. And then employers can give employees up to $5,250 a year for tax-free student loan payments through the end of 2025. And this can't be a pick and choose scenario. You can't say, hey, I'm only going to do it for these employees and not those employees. So there are what they call discrimination rules with workplaces and benefits that are out there for your staff. And so pretty interesting stuff. These are kind of not as common, but we thought we'd mention them. And then there's all sorts of interesting education and student loan stuff. And so again, I'm going to let you go through the student loan scenarios, because there was a lot of back and forth legislation, and this was like, part of the presidency, and election conversation as well. So let's keep rolling. Go ahead, Cian. Oh, you're muted. I can't hear you. Your mic's out. Are you there?
Oh, I'm here.
All right. Go ahead.
Yes. So, yes, and there's still ongoing legislation. So there's still things that are pending, and I'll touch upon those. But with the direct federal student loans, as you may know, if you have a Department of Education loan directly with the federal government, those interest payments have been set to zero since March of 2020, and now it's been extended through September of this year. So you don't owe any interest from March until the end of September, and those payments are waived for the time being. And so there's a couple of ways you can take a look at this. One is you can say, great, I want to pay it off a little bit faster because I would be making these payments anyway, assuming that you have the income. Obviously, he passed this legislation because they wanted to help people with unemployment or underemployment. But if you still have your pay, it's one way to pay it off faster. However, there is talk, and it's still talk right now, that the Biden administration may forgive $10,000 in federal student loans. And so if you have loans that are less than $10,000, you may want to not pay it off just yet and see what happens with that legislation. So that's good news. Oh, and the other great news is that if you are doing public service loan forgiveness, like a teacher, emergency worker, that type of thing, and you qualify for this loan forgiveness, these missed payments still count towards your 120 payments. So that's even better news. So, yeah.
All right. So we're going to dig into some of the education credits. So this is more focused around college tuition and so forth. And I want to stay on time, so I'm trying to not cut short on the slides, but I also want to make sure we finish. So because we have a little bit more information to get through. All right. So American Opportunity Tax Credit. This is probably the most common tax credit that we see, and there hasn't really been much that's changed on this, right?
Right. There's been no changes on the AOTC, but I just wanted to highlight, because this is the most often used and the best credit if you have an undergrad student and they're taking more than a 50% course load. So you can get up to $2,500 per student per year, but a max of 4 years. So you want to make sure you pay your tuition in 4 years rather than 5 years if you can manage that. So, and we are happy to go over this with you on your tax return. That's not a problem.
Yeah. I think every parent that's paying for college, for those kids that are lucky enough, are hoping they'll pay all those tuitions in 4 years instead of 5 as well.
Now, the one thing about the American Opportunity Tax Credit is that if you make over 180 as married filing jointly, $180,000, you no longer qualify. So that's something to keep in mind.
Right.
Now, there are other education benefits that have passed. So any emergency financial aid grants that were given from March 2020 going forward, I think that is also not included as income. And there are a couple of other ways that you might be able to get education credit. The lifetime learning credit is a good one too if your student is less than 50% undergrad, or perhaps in grad school, or perhaps you're doing professional development. So that's something to look at as well. So we can help you walk through these.
We should mention that, a lot of times when we're doing taxes for clients, we're a little bit on autopilot in terms of figuring out which one of these credits are the best for them and to maximize them and so forth. So, we certainly want to have the conversation, but we're also just as default trying to look at these credits to see which one you should take advantage of and which one would provide you the most tax benefit. All right, so let's move on and talk a little bit about some additional tax savings strategies that are out there. So this is going to get into, your more about around itemized deductions. So we're switching from credits back to deductions, and we're talking about, for those people that itemize. Joe, do you want to go through the medical expense deductions and the mortgage insurance premiums and that sort of stuff? Does that sound all right?
Sure. The medical expense deduction, and what we're talking about here really is the floor that you must get above before your medical expenses actually become a deduction. So
Okay.
that was scheduled to go back to a 10% floor starting in 2020, and that was rolled back to 7.5% permanently, or until the legislation changes it again. But in round numbers, if your adjusted gross income was $100,000, you have to exceed $7,500 in medical expenses, which can be insurance premiums, out-of-pocket costs, co-pays, before anything actually becomes an itemized deduction. So that first $7,500 is that floor. It was going to be 10%, but now 7.5%. So that's a good thing.
So really quick, if I have $7,510 of medical expenses, how much is deductible?
$10.
$10, right?
That's about 10. Yeah, everything above the 7,500 is the deduction.
Want to make sure everyone's clear on that. All right, go moving on.
And then they reinstituted, or I should say, extended mortgage insurance premium deduction. So there are some income qualifications to get that mortgage insurance premium deduction, but through 2021, you can still deduct that as an itemized deduction in your tax return. And then we briefly touched on the new qualified charitable contribution deduction, which is $300 in 2020 if you're taking a standard deduction, and will be $600 for joint filers in 2021 if you're taking a standard deduction.
All right. This was really interesting, this qualified disaster-related distributions from IRA. So this is a part of legislation that passed this year. So if you had to take a COVID or other disaster hardship withdrawal from your IRA in 2020, the 10% early distribution penalty for being under the age of 59 and a half does not apply. You still have to pay tax on the distribution. What's really interesting is you can elect to spread the reporting of the distribution over 3 tax years. So go ahead.
And you can pay it back.
Yes. Yeah. And you can pay it back as well and not have to report it. So,
Right.
We talked about, qualifying for stimulus and how that's recalculated if your income drops. So this is an example. I had a client this year who took a hardship distribution, and that hardship distribution pushed him over the threshold, in 2020, and he was over the threshold in 2019. But by making the election to spread it out, it lowered his income, and he was able to get some additional stimulus. So this is a really, really interesting provision. So basically, if you took 90 grand out of your IRA, so considered a COVID related distribution, pay tax on 30 grand of it this year, 30 grand 2021, 30 grand 2022. So
to the extent that you didn't pay it back, yes.
Yep, to the extent you didn't pay it back. Exactly. And then I'm going to flip back over to tax credits. So these are always moving targets. Joe, do you want to go through some of these tax credits for us?
Sure.
Yeah.
So tax credits. So the first one is the child tax credit and earned income tax credit. They are refundable. So these are for low income people, 2 of the biggest credits. and allow you to get more back than you paid in. And one thing that they changed is you can use 2019 or 2020 income in qualifying, especially for the earned income credit, because as the name implies, you have to have earned income to qualify for that particular credit. So if you had no earned income in 2020, you might not get that money, but they're opening it up to have either 19 or 20 income apply to the 2020 credit. It's kind of weird, but for those people that apply, it will be a good thing. The non-business energy credit was extended, the $500, which is 10% of windows, doors, insulation, things like that. It is a lifetime limit. So if you've got that credit in the past, you cannot, get it again, but it has been extended through 2021 as a credit that's available for people that are buying a house, but essentially the first time and not had that credit in the past. And then of course the qualified motor and two-wheel vehicles credits, and then the residential or solar credit. The solar credit is still going down, and it's going to be 22% this year. And right now it is scheduled to end in 2021. So that's pending legislation to see if that most likely will be extended into 2022 and beyond, if the Biden green tax plan, goes through.
Right. So the property credits, the energy credits, you always want to have your receipts on those things. For solar, the switch has to be flipped and it has to be on before December 31st to qualify. So buying the solar and laying it on your side yard and not installing it does not allow you to qualify for the credit. It does have to be turned on and active. And you, with anything, these solar credits are huge. They're, for some people, thousands and thousands of dollars. So you definitely want to have paperwork in good order. You don't actually physically submit it with your return to the IRS, but if it ever comes into question, the burden of proof is on the taxpayer to show that they actually did shoulder that expense. So business.
One little side note about the solar is that anything that you use to power a spa does not count. Now, if you add the spa after solar, then that's okay. But if you're using the spa part, it doesn't.
Yeah. How they figure that out is yet to be seen. But, all right. So business deductions. So common question this year. Ari, I've been stuck at home, working from home. My employer, all they did was give me a laptop, but I've had to set up an office in the back room and so forth. What can we do? Is there any write-offs here? The short answer is no, not under federal tax law. There's nothing that can be done. So I just wanted to get that question out of the way because that's been a pretty common one this year from a lot of folks. But as a self-employed person, travel expenses, airfare, hotels, transportation to and from. If you have a home office that's used exclusively and regularly for business, there's some potential deduction there. If you have any questions about what that means, just email us and we can walk you through it. The meals, if purchased from a restaurant, you can take up the usual 50% of your meal deduction. And that's new in 21 and 22, but is not available in 2020, right, Sion?
The 100% is not available in 2020.
Right. But so this year, in 2021 and 2022, yes, if you're self-employed or you have a small business, buy from restaurants.
Yeah. So 100%, 21 and 22, up from 50% in 2020, right?
Yes.
Yeah. And then PPP loans is a question we have, and it's one of those things where California law doesn't fully conform to federal law. If you're self-employed and you got a PPP loan or an EIDL loan or any other type of COVID loan that we don't even know about, you need to let us know about this. We can probably have an entire webinar on this topic, so we're not going to dig into that too much today. As far as unemployment is concerned, unemployment is taxable federally, but not on California. There is some pending legislation out there to make a portion of your unemployment free from income tax. It has not passed yet. I probably have about 7 tax returns sitting in my drawer that I haven't processed, because if this pending legislation went through today and those returns were processed, we'd have to go back and amend them. So we're kind of keeping an eye on that legislation and to take action. But the number that's been floating around is maybe upwards of $10,000 of unemployment is tax free, I've read, but we'll see what happens when it hammers through Congress. The Savers tax credit. Go ahead, Suzanne. Sorry.
I was just going to say, related to unemployment, perhaps if you got unemployment, your income's a lot lower than you anticipated, or it has been in years past. Now, the Savers tax credit is not something that most of our clients qualify for, because this is really for low to low middle income taxpayers. As you can see, that the limits are quite low. But perhaps you have an adult child who's just starting out, and if they're single and they make less than $19,750 as adjusted gross income, this is a great credit and something to, it's still a good habit. So if they make less than $19,750 and they put $2,000 into an IRA, they can get $1,000 as a credit. And that's a credit. That's not even a tax deduction. So they would get an additional $1,000 back on their tax return. So just something to be aware of.
All right. So a couple other last minute tips and strategies that we're going to go through just on taking advantage of everything that's out there in the tax law. There's all sorts of things you can do. There's something called tax loss harvesting, bunching deductions, so you can itemize one year and maybe not and take the standard the next, and so forth. Joe, why don't you talk about tax loss harvesting? I'll talk about bunching deductions, and maybe CN, you can talk about the HSA stuff. Does that sound all right?
Sure.
All right.
So tax loss harvesting is really an investment strategy. So you're matching stocks or funds that have a loss in them and selling them to offset gains that you may have already received from other sales that you did. As an example, and obviously the time has passed, but when the market fell back in March and April, if you had sold some positions that had a loss, you could have booked that loss against future gains.
Yep. And this is something that as advisors we tend to look at once or twice mid-year, end of year for clients, and just kind of do a little portfolio review. And hey, if there's something where we can make some adjustment and just take advantage of that, why not, right?
And if it makes sense, exactly, because you don't want to. This is one of those things where you don't want to drive the investment decision based on this tax benefit, but it is there in circumstances where it's beneficial. And you do have to do it by December 31st of each year to be effective in that tax year.
Yep. So bunching itemized deductions. So this is an area, we went over the standard deduction earlier. It's upwards of $25,000, rough numbers for most people. So a lot of people don't itemize. But as an example, we had a client that had some really expensive dental work done, and we suggested that instead of starting the process in November and finishing it in February, they waited and had all of that dental work done in one calendar year, so that it got them over that 7.5% AGI threshold and allowed them to at least get some tax benefit from that. So this is something you can do. I have another client that makes a large contribution to his church every other year so that he can get the tax benefit that way. So there's certain things that you can do to kind of help leverage the tax law to your advantage. Suzanne, what about HSA accounts? So this is one of those federal and state don't conform rules that are out there too, right?
Right. So you have, I'm sorry, I was going to talk about FSAs, the flexible spending accounts, because that's also COVID related. So typically that's use it or lose it. You put in some money into a flexible spending account and you need to use it for medical savings medical expenses before the year end, or you lose it. And in most years you can roll over $500, but because of COVID, they realized a lot of people put off a lot of their medical expenses. So you can roll over more of it for 2020 and 2021. Yep. And the max contribution is $2,750. But you can check with your employer. They may have allowed participants to roll over more. So.
Okay. Yeah, and then for HSA accounts, so this is a health savings account. This is different than a flex spending account. HSA accounts are, one of those above the line deduction items for most people, kind of like an IRA is. And these HSA accounts aren't designed to help you pay your medical premiums. What they're designed for is for your copays, prescriptions, doctor visits, medical supplies, dental, etc. And HSA accounts deductible on the Fed, not on the state. A family can put away, I believe the limit is $7,100 or $7,200. I can't remember off the top of my head for 2020 and 2021. So
right, and like an IRA is one of those things that you can contribute by April 15th for 2020 and still get that deduction on your tax return. So even if you didn't do it all through payroll at work.
Yep. All right. So I think that brings us to the end for today. So we have a couple of webinars coming up. Thursday, March 25th is our debt management webinar that we're providing. And then we're having our annual parking lot shred party Saturday, April 24th from 11 to 1. And I think this is going to be a drive-through event where you can bring in and get some boxes of paper shred and so forth. So we'll be sending that information out in our newsletters. All of our webinars are available for review on our website. Our website is mypremierwealth.com. And if you click the events tab, you can find every single webinar we've done over the last year and a half or so. I just wanted to touch really quickly on our second opinion service. If you have friends, colleagues, et cetera, that want to get a second opinion on how their investments are structured, this is a service that we offer. Just reach out to us and we can kind of walk you through what that process looks like and provide some perspective for people. And I think that's it. We're on social media. If you scan those QR codes, you can find our LinkedIn and website, Twitter, Facebook, etc. Did I miss anything?
If you sent in some questions that we didn't get to, I tried to respond back to as many as I could. But if we missed some, please send us an email and we will definitely follow up with you. Thank you so much.
All right. Have a good day, everyone. Thank you.